if someone had walked into the studio now and said they want 15 minutes of our time, they've never invested before. They've got a significant amount of money, let's say they've got R500,000, and they don't need the money for the next 5 years, but these are the rates that they can get at the bank, and we could present it with fixed interest rates that we could get at 2 or 3 different banks, and they're quite attractive from a few points of view. Number one, they're decent figures between, let's say, 5.5% and 7%. They therefore give no risk because you'll get them if the repo rate goes down, which is not going to happen. That's the only sort of downside. Who cares about Brexit and Trump and elections? Doesn't affect that sort of investment. But they come to us as little jingle and little sparkle in the eye to say, but apparently I could do more if I speak to clever people and we take on a little bit of risk. And they've got a 5-year horizon. What would be the typical conversation we'd have with this person?
So, Avi, while it might seem attractive looking at 5.5% to 7% bank rates, you mentioned no risk. I would argue there is a risk. It's inflation.
Just say I don't agree with you.
I don't agree with you. Being polite. There is a risk, inflation. I mean, we have inflation at 5%. So if
which
you're earning,
ultimately is our biggest risk.
Exactly. So if you're earning 5% at the bank, in real terms, you're actually going nowhere. It's zero. So if you have a 5-year investment horizon, we need to go up the risk scale. So you need to include in a portfolio equities, bonds, properties, and real return assets. Our starting point at Cannon Asset Managers is that we believe asset allocation is your most important factor to consider. So while we'd obviously need to analyze the client's needs and their risk appetite, we ultimately believe step number one is asset allocation, and from there we would build perhaps a multi-asset class, a multi-asset portfolio for the client, which in real terms can give you anything between 10 and 15%, depending on how much equity exposure you can tolerate. But that's a better solution for a client with, like you say, 500,000 Rand, 5 years, and is willing to take a bit more risk to get higher returns.
You said between 10 and 15%. We haven't seen 15% of the market for a while.
Yes.
And then you said if they're prepared to take more equity allocation on. So are we saying that we expect equities to really perform or to deliver within the next year and a bit?
Probably not 15% within the next year. I mean, what SA equity needs is growth. Locally, within the next year, growth is likely to remain anemic.
Right.
And with the uncertainty of elections, I don't see any major changes happening to growth. So, I mean, equities over the next year, you're probably looking between single digits and maybe low double-digit returns. The benefit is that with the shares derating, they're sitting on actually very attractive yields. So equity yields our equity portfolios are yielding between 4.5% and 5%. So quite high dividend yields, and you just need a bit of capital appreciation, and you're at 10% for equities. But Avi, that's why we look for multi-asset portfolios, because there has been asset classes that have delivered what you refer to as 15% over the past year. Preference shares, which is a unloved and often forgotten asset class, actually delivered 14%. So it's a little shy of your 15%. But in 2018, preference shares after tax and fees delivered 14%. So that's why asset allocation during these uncertain times is so critical, so that you can diversify across different asset classes that can provide you different returns in this environment.